Hello, everyone. So today we have a guest for the first time, and I made a little presentation for Matt and our guest Robert. So maybe Robert, you can say a sentence about who you are, just for everyone. Robert is an old friend of mine. Matt and Robert haven't met before today, so it's the first time for all of us to sit together and talk. And yeah, Robert.
Yeah, first of all, cool to be here. I'm an SEO manager. It's like Google marketing stuff. I'm not very well versed on finance stuff, so I'm curious to learn a bit about ETFs, these kind of things. And
yeah, thanks. Just a little bit of background. So Robert and I, we met many, many years ago, and just a few weeks ago, we had lunch together, and we started talking about personal finance and investing. And I said, "Hey, why don't we make this conversation into an episode for our podcast?" And this is where we are. So I made some slides, which of course you guys can't see, but my idea is to just go through it, walk you through my thoughts on the subject, and then whenever you have questions, just ask me, and open discussion. We're just like spitballing it. So yeah, you can
Sounds
interrupt
good.
whenever.
Welcome, Robert, and nice to have you here.
thanks, Matt. Thanks, Tim.
So just a little disclaimer, of course, I'm not a finance expert. I'm not a financial advisor. I didn't study finance. So all of what I'm saying is from my own reading of the literature and my experience. Just a quick disclaimer, so no one sues me for bad advice, but this is the best of my knowledge, okay? So, of course, there's many reasons to invest your money. And, some people might think investing is stupid and so on. And, it's fine. It's not for everyone. But what are some reasons why you might want to invest? So there's, of course, many reasons to invest. There's some obvious reasons, like you want to increase your wealth and financial security over time. Maybe you want to create sufficient funds for emergency situations and or for your retirement, right? This is a common goal, especially in Western countries where we want to create some wealth for the future, for our retirement or family. Also, there's the consideration of inflation. So many of you know about inflation. Inflation is prices of or the cost of living increasing over time. So uninvested money that just lies around in either in your bank account or under your mattress will lose value over time. So you want to preserve purchasing power. That's another reason to invest. There's another category of people that want to create passive income or financial freedom. So you want to decouple your quality of life from your job, right? So maybe even not have a job at some point. And if you have a steady income stream from your assets, that means you can, pursue other hobbies or whatever and not work 24/7 on your daytime job. There's also certain goals that we might have that require funds. So maybe we want to start a company or a nonprofit or an art project and so on. So that's another good reason for some people to invest their money and grow their funds to be able to do this. And in general, I think building a diversified portfolio of assets to manage life risk in general is a good idea. So that's another reason, because if you have everything, all your assets in your bank account or all your assets in your apartment or whatever your main asset is, it is the riskiest way to store your net worth, because if you spread it over many vessels of investment, then any emergency or any downward spiral in one area of your life will not affect the other areas of your investments. So before we start on investing, I just wanted to cover some personal finance basics, because I think there's some things that everyone should consider before they start investing their money. So I think it's important to kind of cover the basics, and I won't spend much time on it. I just want to mention them. So I think if you're interested in investing, maybe you already have these basics, but I'll mention them anyway. So the first one is budgeting. I think it's good to start tracking your income and expenses and figure out where you can reduce expenses and or increase your income, right? I think that's a basic thing. If your expenses are larger than your income, I think investing is not for you. You need to figure out the basics first. If you have large amounts of debt, I think you need to think about reducing your debt first and or avoid debt to begin with, and understand refinancing and so on to to make sure that you get rid of that debt before you start investing. One of the biggest ways to get instant return on your money is to get rid of your debt, because debt costs you interest every month or every year. I think it's important to also think about life emergencies. So if you want to start investing money, make sure you have a highly liquid emergency fund lying around somewhere on a bank account or even in cash. And this is what people usually suggest: 3 to 6 months of monthly expenses. So you might lose your job, you might have a medical emergency, there might be a natural disaster, anything you might need to deal with in the short term that you can't predict. It's good to have money that is very highly liquid, or liquid assets lying around that you can turn into money quickly to be able to deal with these emergencies. I think this is what I already said. So understanding debt and reducing your debt and unnecessary expenses is a direct way to effectively grow your wealth. So it's not only about investing, it's also about cutting down unnecessary draining of your wealth. Then, of course, you can think about additional income streams if you think your expenses are too large and you can't cut them down further, and also understand the monetary value of your time. Lastly, I think it's important to have a positive savings rate before you start investing. So this is just a summary of what I just said. If the money in your savings or bank account grows every month because you have more income than expenses, then it's a good time to start thinking about investment. Probably not before, at least not for everyone. So before I start about the details on different asset classes and how to invest, I want to talk about something that we call the risk and reward ratio, or generally the terms risk and reward. I think many people have an intuition for them, but maybe we can clarify a little bit. So usually, and this is, I think many people have intuition on risk and reward from examples like the casino or insurances and so on. The risk tends to scale with the reward. So the riskier the bet, the higher the reward, but also the more likely you can lose whatever you pay. But contrarily to the casino, most forms of investment that we're going to talk about have a net positive expected return over time. So the casino has a net negative expected return over time. If you keep playing with money at the casino, you will lose money. But with the investment or asset classes that I'm going to talk about, most of them, you have an almost guaranteed increase in your wealth over time, over a long period of time. This is not true for all types of investment, but I would categorize the types of investment where this is not the case as gambling or speculation. But most of the asset classes that we're going to talk about have a positive expected return. So if you stay invested for long enough or a large amount of time, you will have a positive return. This is not like the casino. And so what I wanted to say about this risk reward ratio is that different asset types have different expected long-term returns, but those with the highest long-term returns usually also have the highest risk associated with them in the short term. So the ones that give you an expected return that is very large after, say, 10 years, also have a high risk of losing all your money, say, in the next month. And this is something to keep in mind, because this will govern all of our decisions when we invest our money. Exactly. So two of the very common ways to mitigate risk, there's many ways to mitigate risk, but two of the common ways are diversification, so spreading your money into different asset classes, and time, because the longer you wait, the more likely your return will be positive. So let's talk about some asset classes. I'll give you some example for different categories, and this is in no way very clear, but it's all on a scale. So I'll talk about the different types. So there's the very low risk and low return types of assets. So cash is the most obvious one. If you have cash lying around, it's very low risk in terms of just losing it all. I mean, you can lose it in a fire, obviously, but it won't disappear because of an economic crisis, except, of course, inflation. Inflation will cut into your savings. The same is true for a savings account. The savings account is a little bit higher return usually than cash, because there's usually an interest rate on your savings account, but this is not true for all bank accounts and all countries and so on. So it depends a little bit on the context. There's related asset classes like certificates of deposit. Those are ways to lock away your money or give your money to a bank for a fixed period of time. So you, for example, you can say, take my money for 6 months. I can't touch it for 6 months, but I get a larger interest on my money than a savings account. Then there's so-called bonds. So bonds are other ways of lending money. You can lend money to a government or to a corporation, and this if you lend your money for a short amount of time, this is called a low yield bond. High yield bonds are usually more risky types of bonds, but in general, it's lending to a corporation and or a government. And if you lend your money over the short term to the government, at least in Western countries, this is often called the risk-free rate of return. So if your government guarantees you the return of your money with a guaranteed interest rate, people often call this the risk-free rate, or at least it's closely tied to the risk-free rate. So whenever we talk about asset classes, we always compare to this rate. So cash has a basically negative rate of return compared to the risk-free rate, because the government can pay you more money than if you just let it sit under your mattress. And then in general, this entire category that I'm talking about is forms of lending money to people, right? So you lend money to the government, you lend money to the bank, or you lend money to a corporation. Then there is the more medium risk and medium return types of assets. So examples are a well-diversified, high-quality stock portfolio. We sometimes call them blue chips, for example. So this is a type of investing sometimes called dividend investing, where those are corporations that have been around for a long time, and they tend to not grow so much anymore, but they distribute dividends to their shareholders. Dividends are them sharing their profits with their shareholders. Ideally, you have, I said, well diversified, and we'll talk more about this after. Ideally, you don't have a single stock in a single company, because there's risk associated with just owning stock in a single company, because something might happen to that company. And I think this is something in general to think about. You want to spread your money over different types of assets, and also within an asset class, different companies and so on, to reduce the risk. But reducing the risk will reduce the potential reward as well. But in general, this is a good strategy. I think diversification is one of the best ways to mitigate risk in investing. And one of the more modern ways to do this is through an ETF. So an ETF is similar to a mutual fund in that it's more or less actively, sometimes very passively managed fund, where people pool their money together to buy several companies or several assets, and then treat them as if it was a new type of asset, and distributing shares for that pool of money that is invested in several things. So basically, it's just a group of people buying different types of companies or different types of stock or whatever asset class it might be together, and splitting the revenue from all that. And that way they distribute the risk and the reward between everyone that participates. And you can buy a share of a fund at the stock exchange through something called an ETF. So that's ETF means exchange traded fund. That's what it stands for. And this is exactly what I just explained. Also, if you really care about real estate, we'll talk a little bit about real estate, but there's a way to invest your money in real estate through something called a real estate investment trust, sometimes called REIT, so REIT. And this is similarly to an ETF. It's a way to share the rewards of owning many different objects of real estate, houses or apartments or offices and so on, but shared with many, many people. So you can share the reward and the risk and not have to buy several apartments yourself, because there is a risk of owning single objects by yourself, because something might happen to that real estate object that reduces its value, and or you might go bankrupt and so on, and you spread the risk between many people. And a REIT, or a real estate investment trust, is a way to invest in real estate without that risk. Excuse me. Then the next category is a well-diversified portfolio of growth stocks. So I talked about the blue chip dividend stocks before. So I'll talk a little bit about how stocks work after. In general, those are companies that maybe have not been around for as long as these old companies that pay a lot of dividends, but they have a good track record of growing in value. So the company doesn't distribute their profit to the shareholders, but they reinvest it into the company. So the value of the company increases, and thereby the value of the stock. the next category I would still call it medium risk and return is direct property ownership. So real estate, so you can buy a house, you can buy an apartment and so on. However, there's the risk associated with that is that usually a single person cannot afford many objects and thereby doesn't or cannot spread the risk of owning this real estate, because an object of real estate can have issues that reduce its value, and it might even there might be a market when you need to get out and you cannot sell the apartment, so the effective value of the apartment is zero. So that's a very high risk. And lastly, in this category, I would put high yield bonds. So similarly to the bonds I talked about before, government and corporate bonds, there are high yield bonds where either they're very long term, so there's some risk associated with the maturity, what it's called. So how when the loan becomes due, or the institution that you lend the money to is considered a risky institution. So it's safer to lend money to the U.S. government or the German government than to the Greek government, or I don't know, the Afghan government, for example. Those are very high yield bonds because they're very risky. You might not get your money back, but there you get a big reward for lending them your money. And this is just how the free market works. So then there's high risk types of assets like small cap stocks, so very small companies that are still, in the growth phase. Emerging markets, which means stock in companies in countries that are in what we call emerging, so not Western countries usually, but maybe countries in Africa or Asia and so on, or South America, where the future is less predictable. And then there's other types of asset classes that are high risk, like commodities and futures, but also physical assets and collectibles. Like you might own actual art and or trading cards and so on. Those are types of high risk asset classes. And you might, in some instances, you might call them gambling or speculation instead of investing. And then there's very high risk types of assets like cryptocurrencies and stock picking. So stock picking just means picking single companies and thinking that they're going to outperform the market, which is very unlikely. If you don't have any inside information, this is extremely difficult to do, if possible at all. Startup investing, so you can invest your money into a startup company. And there's more advanced stock market trading types like options trading that is also highly risky. So yeah, this was an overview of types of asset classes. And then I'll talk a little bit more about the risk return or risk reward ratio. I just want to say that it isn't perfectly correlated, and the risk tolerance of different people is a personal preference. So it is important to say that the risk reward ratio isn't the perfect trade-off. So some asset classes are probably objectively better than other asset classes in both risk and return. So I'm just going to give a very random example, but it's probably better to have a very well diversified portfolio of bonds that is then a collection of fridge magnets that you think are going to increase in value, right? So one is very highly speculative and the other one has a very good track record of returning money. So I would say that objectively the portfolio of bonds is both safer and higher return than the collection of fridge magnets. This is just an example. Fridge magnets, because I don't think many people are collecting them, but there are other types of collectibles that are very probably very speculative. I would also argue that owning a 500K apartment is higher risk and low return than a well-diversified portfolio of stocks of equal value. But this is more in the direction of my opinion than hard facts, because there's definitely many people that grew very wealthy with buying apartments. But I think in general, the data seems to show that owning single apartments is both lower return and higher risk than a well-diversified portfolio of stocks of equal value. And I think the same is true for, say, 500K worth of gold. If you have gold lying around, gold doesn't pay dividends. So if the market is down, your gold doesn't keep paying dividends. So an apartment and stocks keep paying dividends, even if the market is bad, usually. Additionally to the risk and reward, I think the type of asset that you pick is also a personal preference. I think some people like to be able to touch their assets. So I think some people just prefer buying a house and that's fine. I think you can be irrational to some extent. And it's also, I think, for many people that are not super rational, it's a good thing that they cannot see the value of their asset fluctuate on a daily basis. So most people that buy an apartment, they don't know that the value today is less than the value yesterday, because they're not trying to sell their house every day. But the stock market is inherently more nerve-wracking, I think, because you see the value of your stock going up and down, even though there aren't huge changes to the companies you own every day. Maybe there's some, some new patent that a company filed or something. Those change the value of a company. But again, there's also things that affect the value of your house that you don't really know about because you can't track the value of your house as easily. So it's maybe better for some people that get highly emotional about these kinds of things, because you want to reduce your stress and not increase your stress. And also you don't want to make snap decisions like sell your house when the value is really low. And in the same way, you don't want to sell your stock when it's really low. So you don't want to be emotional about this kind of decision. And I think it's, for many people, real estate might be better because of these reasons, but it doesn't make it a better asset class to own objectively on a math investment basis. Lastly, I think a reason to own an asset that is not objectively the best is that some assets values can be influenced. So this is true definitely for direct real estate ownership or startup investing, right? You can, if you own a startup or you own an apartment complex or whatever, you can affect the value of your asset directly by remodeling the house or renovating it. And in the startup, you can invest time. You can basically invest time to improve the value of the object. This is not true for stock, usually. If there is a way to influence the value of the company that you own, usually you are, on the board of the company, or you own the company, or you work for the company, but then this would be legal. So the same is true for having extra information about the asset class. You might be very good, or you might have a lot of information or a lot of knowledge about real estate, and this might make you more able to generate value and or increase your wealth with real estate. This is very difficult for the public markets because everyone has the same information. And if you do have some inside information, you're not actually allowed to act on it because this is called inside trading and this is illegal. So yeah, those are reasons to not own stock and or assets that can be traded on the public markets. But other than that, I think the public markets are usually the best place to put your money. So I'll talk a little bit about a little bit more in detail about the different asset classes. So there's the first type of asset class, which is lending you money. So I mentioned this before. Most of the very safe assets are in this category. So you lend your money to an institution that very, very likely will return the money to you plus some interest. So banks can give you interest on your money. So you can just put your money into a bank account and they will pay you some interest, and they lend your money to other institutions and generate very high interest. And some of the interest will go to you. But they can lend it to governments, to companies, to private people and get a really high interest rate. And a small percentage of that interest rate goes to you because you lend your money to the bank. You can get a higher interest rate if you lend your money directly to these institutions instead of going through the bank, because you share the profit with the bank. So you can you can sell, or you can lend your money to a government and or company or private people directly. And this is called a bond. If you lend your money to the government or a corporation, this is called a government bond or a corporate bond. And that way you can get more interest for the money that you lend. Usually government bonds of developed countries like the US or Germany or other more developed countries are considered risk-free or low risk, and because they usually pay back their lenders. And the short-term version of these bonds is often called the risk-free rate. I mentioned this before. Long-term bonds tend to have higher returns, but they're also higher risk. So it's a different type of bond that you can own. So you can have a bond with a 6-month maturity, or you can have a bond with a 10-year maturity. So it's whenever the money has to be paid back and the risk and the return increase accordingly. Government bonds tend to be safer than corporate bonds for at least developed countries. I think this also makes sense. The government is expected to be around for longer than the average company. Interest rates are proportional to risk. I said that as well. So US bonds have lower risk, but also lower interest rates than, say, Greece or Argentina, because the economy of Greece is less stable than the economy of the United States. So the interest rate for government bonds in Greece is higher than the government bonds in the US, and so on. Lastly, and I mentioned this before, ETFs are a way to spread out the risk of your investment. So instead of buying a bond for Greece and a bond for the US, you can buy ETFs for categories of bonds. So for example, you can buy an ETF for government bonds in the Western Hemisphere, or government bonds all over the world, or government bonds only in Europe, and so on. So those are ways to easily diversify your portfolio. And this is true for all kinds of asset classes. And again, you can interrupt me at any time if you have a question. No questions? Are you guys still there?
I am.
So good so far.
Okay. So the second type of asset is assets that you own. So there's physical assets, right? Real estate and collectibles, so trading cards or apartments and so on. There's commodities, which you don't physically own, but it's kind of like a slip of paper that says that you own gold somewhere, or oil somewhere, or gas somewhere, or grains and so on. Those are called commodities. And commodities are different from other physical assets in that they're not individually priced, but they're market priced basically for the entire market. So gold is worth the same everywhere, but your apartment isn't the same everywhere. Not all apartments are worth the same everywhere. That's more or less the difference. And then there's company ownership. Company ownership can be as a founder of the company, as an investor in the company, or, and this is the one that matters to us, as the owner of shares of a public company. So it's not easy to own shares of a private company. You have to be somehow involved in the company, but you can easily buy shares of a public company. That's the difference, right? You can own part of Apple, you can own part of Microsoft, you can own part of Google, but you cannot easily own shares in a startup in your town, or in maybe your grocery store or something, unless it's a big grocery store chain. Then you can buy shares of that grocery store chain. Exactly. So stocks, we often talk about stocks. Stocks are literally just the shares of a publicly traded company. So a single stock is a share of a publicly traded company. The company can decide how many shares it issues. So say the company splits its own ownership up into 1 million parts, then there's 1 million shares for that company, which we call stocks. So you literally, if you buy a stock of a company, you're part owner of that company. This is in the most literal legal sense. You're an owner of the company. You can also technically then make decisions for the company, but it's, because you don't usually own a lot of the shares of the company, because you're not a billionaire, it means your voice is usually very small, but you are allowed to vote on certain issues when you own stock for that company. So you're, in the most literal sense, you are an owner of the company. This also means that if the company makes money, you make money. If the company goes bankrupt, your stock will lose its value, right? This is, in the most literal sense, you're part owner of the company. So whatever happens to the company happens to your stock. The profits of the company can be distributed to the shareholders. So if the company makes a lot of profits this year, it can decide to either distribute the money to the shareholders, so all the owners of the company, or it can reinvest the money into the company. So it buys more assets or increases their workforce and so on. And thereby the value of the company increases, which means you don't get cash, but your stock value increases because the company value increases. So those are two ways that you get a return for an increased value of the company. And this is important because those are two different types of investing sometimes, because some companies choose to pay more dividends and the stock value stays more flat, but some companies are more likely to reinvest their money into growing the company, and they don't usually pay a lot of dividends or no dividends at all. And we call them these types of investing, we call them dividend investing or growth investing. So these, I mentioned that before, these so-called blue chip companies, for example, are the ones that have been around for a while and they just pay dividends to their customers, but the shareholders, but the stock value stays pretty flat or increases very slowly over time. And then there's the so-called growth companies, which have been around for a shorter period of time, are very innovative and reinvest their money all the time. I think a good example is something like Tesla, but other companies exist that reinvest their money all the time. A lot of tech companies are like that. And they usually increase the value of the stock very quickly, but there's a lot of risk associated with that, but you don't often get dividends with these companies, so you don't get cash. Which one is for you depends on your preference, but also like for how long you want to be invested in that company and so on. And we'll talk more about that after. Like the personal checklist, I'll talk about at the end. As I said, reinvesting usually will lead to an increase in the share price because the company value increases. Distributing dividends usually leads to a small decrease in the share price because the company value decreases for the short term because it gives away part of their value to the shareholders, right? But this is usually a very short term effect. It doesn't last long usually because it's paying dividends. People want to buy the stock, so it increases the value of the stock and so on. One important thing to note is that the stock value is not calculated because of the value of the company. So it's not directly reflecting the value of the company on, if you look at the books of the company, but it's the market's opinion about the long-term value of the company. And this is really important. So the expectation for the future returns of that company are priced into the price of the stock. So if a company is very expensive, we say it's expensive if the stock's very expensive. And I don't mean the stock is $100 versus $10 because we don't know how many shares there are. So you always have to look at the so-called market cap or market capitalization of the company. It's the total number of stocks or shares issued by the company times the value of each share. The actual price of the share is irrelevant for how cheap or expensive the stock is. It's the total value of the company compared to the book value of the company, right? The market capitalization or the total value of the stock of all the shares that the company has issued compared to the book value of the company. This is important because the market's opinion about the company might change very quickly, and the price. But usually the assets of the company that the company owns and the business model of the company doesn't change quickly. So I give you an example of this. So General Motors has been around for a very long time, and the production of cars of General Motors far outpaces that of Tesla, and it's been around for much longer, and it seems like the much more valuable company. But Tesla is actually more valuable because the opinion of the market about Tesla in the long term is more positive. So people expect Tesla to, in the long term, become more valuable than General Motors, and that's why the market cap of the company, so the combined value of all the shares of Tesla, is higher than the of General Motors. I think this is still the case. I haven't looked in a long time, but I think this is still the case. Correct me if I'm wrong. Do you guys know if this is still the case? I think it is the case.
I'm not sure. No.
Okay. So now let's talk a little bit about diversification. So I mentioned this a couple of times already. What is better, owning a single apartment or 10% of 10 apartments? I think many people will agree that owning 10% of 10 apartments is better than owning a single apartment outright because of reduced risk, but also you spread your wings a little bit and can profit from, because the likelihood of one apartment increasing in value if you have 10 apartments is higher than just owning a single apartment. The same is true for companies, right? Owning an entire company has a smaller risk than owning a small share of 1,000 companies. So an example of owning many apartments is through a REIT, real estate investment trust, and an example of owning many companies is through an ETF, right? You can buy an ETF for the entire S&P 500, which is the index of the 500 largest companies in the United States, and own a share of all of them instead of buying all of them outright. And this is a much safer way to invest your money. A single company can have a crazy increase in value based on some new product or some new invention, or they can go bankrupt and so on. Owning a well-diversified portfolio will usually grow with the average value of all its holdings, right? All the companies that you have in your ETF will grow or decrease in value and so on. And usually this is more telling you about market trends than about the day-to-day of a single company. So single outliers, so a single company might go bankrupt, will have a small effect on your portfolio. It's more about the general market trends. And this is a much safer investment for many people, especially if you don't have any special information about different companies. So it's much better to participate in the economy of the market in general, because usually markets grow, than to bet on a single company. So that's why usually the suggestion for most non-experts is to invest into ETFs or mutual funds, and they're very similar to each other. You can buy shares of the fund that try to mimic an entire market or a segment of the market. So I mentioned the S&P 500 for the United States, or can be the DAX in Germany, or can be the NASDAQ, which is a special market in the United States for technology companies. You can invest in emerging markets, as I said before. So maybe countries that are not in the Western Hemisphere. You can invest in medical companies as an ETF, or in financial companies. So there's different types of ETFs. There's also ETFs for bonds, for commodities, and so on. So any type of asset class you might want to own, you can usually buy an ETF for that company. And that's actually really, really nice for us, because it's very quick. We can make very quick decisions, and we can liquidate them very quickly, and so on. And the market usually has already priced them very well. So what are mutual funds and ETFs? As I said already, they are pooled investments managed by professionals. So instead of going to your local bank branch and asking a financial advisor to manage your money for you or your portfolio for you, you can decide on a segment of the market or an index or a country and so on that you're interested in investing in, and someone will deal with the diversification for you and the risk management. ETFs are just like mutual funds, but they can be bought at the stock market, just like a stock. So that's the difference. A mutual fund cannot be bought at the stock market. An ETF is very similar to a mutual fund, but you can buy a share of the ETF at the stock market. The ETFs are often much more liquid than mutual funds or other types of funds. So there's also hedge funds, which we're not going to talk about. This is not for most people, because they can be bought and sold almost instantly, right? So if you have an emergency, you can get your money out very, very quickly, which is good in a way if you do have an emergency, but it's bad because you might have an emotional reaction to some news and you think you need to get your money out very quickly, and then more often than not you lose money by being emotional because you get your money out at the wrong time. Usually it's best to stay invested. And this is also different to physical assets. This is true also for real estate. You cannot quickly get in and out of the owning the property, right? It's impossible to sell your apartment in 5 seconds. You can sell a stock in 5 seconds. And it comes with its benefits and drawbacks, of course. More emotional people are maybe better off with a asset that cannot be sold quickly. But in general, it's good to have assets that are very liquid. If all things being equal, a liquid asset is good because you can get your money back if you really need it. ETFs are often also cheaper than mutual funds because they're more passively managed. Usually, passively managed means that they are managed by computers often because they're just tracking some index. So they're just trying to mimic the 500, the share of the 500 biggest companies in the United States, for example, versus a person sitting there and picking your stocks every day, which, you have to pay for the time of that person doing it. So the expense ratio, it's called the expense ratio in English, which is the percentage of fee you pay every month or every year to the manager of that fund to manage your fund. So the expense ratios of ETFs is often much less than 1%. So it can be 1% for ETFs that are a little bit more managed than others. If it's just tracking an index, it's often as low as 0.05%, which is very, very cheap. For mutual funds, it's usually a little higher. 1 to 5% is a good number. But the lower the expense ratio, the better, right? So if you have to pick between two ETFs that are very, very similar, pick the cheaper one in an expense ratio. Makes sense. And the more managed the fund is, the more expensive it is in terms of expense ratio or fee. So index funds are usually the cheapest because they're just tracking an index that already exists, right? So this can be very highly automated, and no person's time is needed to manage the fund. So I think lastly, we want to really talk about what's good for me as a person. And I can't tell you what to do, of course. So I think there's a lot of personal preferences. I think it depends on many things. What is your risk tolerance? This is very important because some people are very emotional, and I would like to say that I'm super unemotional and super smart in my investments, but I made so many mistakes because I was emotional. So I think this is something to consider and be really honest with yourself, how risk tolerant you are and how emotional you can get with your money before you make these decisions. So what is your risk tolerance? When do you think you will need your money? Right? This depends on your plans in your life, how old you are, and so on. If you have something big coming up, you might rethink investing your money in something highly risky. What other income do you have? What other emergency funds do you have? If you don't have a job or do have a job that is very secure, really should influence how risky you can be with your investment, right? And same for how likely is it that you will have an emergency? If you live in an area that floods very easily or has hurricanes very often and so on, your decision will be different from someone where there's no natural disasters ever, right? So it's something to keep in mind. And your age is the same, right? So how likely is it that you will have a medical emergency, how long you live, and so on. In general, the longer you are sure you can wait to have your money back, the riskier your portfolio can be, right? This makes sense. The more uncertainty your near future has, the more you should reduce the amount of risk in your investment. So if your job is not secure, if your family planning is currently not sure, so maybe you want to have children, or maybe you're in the process of getting married, or you have some medical issues you have to deal with, and or medical issues in your family, maybe you plan to start a company soon. All these things are increasing the likelihood that you'll need big chunks of money soon, and you might not want to lock away your money for a long time, and that will and should influence how you invest your money. So there's a rule that floating around in these personal investing guides and so on. And again, none of these rules are hard rules, and I also take them from books and so on, right? So I didn't optimize this rule, but this is a common rule. So it's called the rule of 100. So you can subtract your age, and this is all things being equal, right? Like your job security and so on have to be calculated separately. But if you just have your age, you subtract your age from 100. So for example, if you're 30, you subtract 30 from 100 and you're left with 70. And this number is the percentage of your portfolio that should be allocated to equity. So equity means stocks, ownership in companies, and the remainder, so in this case 30, just your age, should be allocated to more conservative investments. And more conservative means usually bonds, but can be savings accounts, certificates of deposit, and so on. So things that almost guarantee you back at least your principal. The principal is the amount of money you lend. Then you're basically sure you get the money back in the short term. So in the example of a 30-year-old person, you might want to invest 70% of your money into a well-diversified portfolio of stocks, and 30% into low yield secure bonds like short-term government bonds, savings account, and so on. If you're more risk tolerant for whatever reasons, your life is very stable, maybe you have a lot of savings, and so on, you can change this number 100 to another number, like 120 is a number that often floats around. So you might use 120 and subtract your age. If you're not very risk tolerant, or you have a lot of life uncertainties in the near term, you can change it to a lower number. So let's say it's 80. At the end, of course, it's your personal preference, right? You can also adjust it over time. You can start with one number and then change it over time. Adjust. You can see how well you react to changes in the value of your portfolio, and adjust over time, right? So especially if you don't put all your money into the stock market right away, you have time to adjust based on your feeling about it, right? As you get used to it. Also, not to forget, there's more than stocks and bonds. So you can also allocate some money to other types of assets like real estate, commodities, cash. You can also start investing in startups if you're really feeling very risk tolerant. You can choose some other investment classes or asset classes. So this, aside from the rule, I think there's some things that I want to mention that everyone should consider before investing their money. So different assets have different taxation rules based on your country. So you might want to think about that. It's a little bit more complicated, and it depends so much on where you live and what your current circumstances are. But you can consult Google and or an accountant in wherever you are, and think about that, because some countries have tax advantages for certain types of investments. Some countries are have very good tax advantages for real estate, for example, and some countries have something called retirement accounts, where you can invest your money and reinvest your money and shift your money without always having to pay tax on them. And this is very beneficial in the long term. But this is something you have to do your own research on. Also, you can, of course, do your own research into what companies and or markets you think are undervalued and will outperform. So if you think you have a lot of knowledge about medicine and medical devices and so on, you might think that investing in the medical market is really good. However, this takes a lot of skill and a lot of time and lots of luck, because figuring out who will outperform who is extremely difficult, if not impossible. So it's not something I would suggest to the average person out there, but it's something you can do. It is widely accepted that you cannot time the market. This means you cannot know when the markets will go up or down, and you cannot really easily wait for a dip in the market or like avoid losing your money by investing your money at the wrong time. So usually the advice is that the best time to invest is now. So if you have money that you know you want to invest, usually the best time to do it is now, because what people say is time in the market beats timing the market. So the longer you're in the market, the more likely you'll have a lot of money. You might regret it. Maybe maybe you're going to be the person that loses all your money right after you invested because the market dips right after, but you cannot know. And there's ways to deal with that. But usually, on average, the earlier you invest your money, the more money you'll have in 10 years. So there's some luck and so on involved, of course, but usually that's the case. If you look at historical data, that has been the case for a very long time. The longer you're in the market, the better. Over the long period, public market investing is almost always positive, right? So if you're not invested in like a super risky market, maybe in a country where there's war and so on, in Western countries, especially in the US, and this is often the gold standard, investing in the US markets, the expected return is positive over the long term. So if you're not impatient or make trades based on emotion, often fear, right? You react to some situation, and I've been there, right? So when Corona happened and so on, for example, I was very scared, and I took a lot of my money out of the market, and I regretted it because there was a huge increase in the stock values after Corona, and I missed out on that increase, on the growth. So the solution, if you can, is to automate your investment, and in general, just like don't look at your portfolio too often. And this is one of the benefits, as I said before, of real estate and other illiquid assets, that you cannot sell them on a whim. It's really hard, right? If something crazy happens, usually you're forced to stick to your investment just because it's really hard to get rid of it. This is not true for stocks. So if you're someone who gets scared easily, this might be a better type of investment for you. And so there's one thing that you can do to mitigate the risk of like losing all your money at once if you're just starting out, and it's called dollar cost averaging. It isn't something that has been shown to work on average well, better than just investing a lot of money early, but it does reduce the risk on average, but it also reduces the potential return for the average person. What this means is that instead of, if you have, say, $10,000 or euros lying around, instead of investing them all at once, you invest similar chunks of money at regular intervals. So instead of investing 10,000 today, you invest 1,000 today, 1,000 next month, and so on. And maybe you can increase it over time. This spreads the risk a little bit of this fear of like a sharp dip in the market right after you put your money. And then there's some advanced strategies, which I'm not going to go into, but if you're getting really fancy about investing, there's options trading, writing covered calls, Forex trading, and so on. But I'm definitely not going to go into them because they're very risky and I know very little about them. Okay, so this is almost it. Just kind of like a quick guide at the end for a person that has never invested and has never really thought about personal finance. Again, I'm not a financial advisor, so everything at your own risk. But this is my quick guide for the uninitiated person. So first thing, get out of debt. If you have debt, try to get rid of it or refinance to get lower interest rates. But getting out of debt is always a good idea. Number two, if you can, reduce your expenses and increase your income. If there's capacity to increase your income, use your time to generate more income streams. That's always a good thing. Start saving money regularly into your savings account. If you can, don't leave it under your mattress, put it in your savings account. Try to not use it just because it's there. Try to increase the amount in your savings account over time. Once you have around 3 to 6 months of emergency funds in your savings account for, depending on your life circumstances, how likely it is that you'll have an emergency. So it's something you have to figure out for yourself. Once you have that amount of money lying around, then it's a good idea to start thinking about actually investing your money. So the next thing you need to do is find a broker or a brokerage account. So often you want to open a brokerage account at a so-called discount broker. There's your country, wherever you are, often will have something called a discount broker. It's a bigger company that allows you to trade trade at the stock markets very cheaply. And usually there's something I should say. Buying and selling stock costs a fee. It's usually very small with these discount brokers, but it's something to consider. Then you can use the rule of 100 or a derivative of that rule. So 100 minus your age, or depending on your risk tolerance, another number, 120 if you're very risk tolerant, or 80 if you're not so risk tolerant, for example, to determine the preferred portfolio makeup. And also, if this is a little bit too wishy-washy for you, there are online tools that you can do that with. So if you just Google portfolio makeup manager or something, or like what portfolio split should I have, I think there's going to be tools coming up in whatever language you're going to be Googling this in. Then I think the best suggestion is always to buy an ETF. You don't have to do that, but I think this is usually the best decision. Determine the type of ETF you want to buy. Do you want to buy an ETF for an index or a segment of the index? So medical only and or real estate only and or finance only. More often than not, I think just buying an ETF for an index is the best decision if you don't want to think so much about this and you don't have any knowledge about this. Think about your geographic preference. Do you want to invest in the US, in Europe, in emerging markets, and so on? Think about the risk-reward ratio. Some countries are riskier than others, but potentially have good short-term rewards. But in general, more established economies are a safer place for your money. For bonds, if you buy bonds, think about the maturity. Like, is it short-term bonds? Those are safer, lower interest rate, or long-term bonds. Those are usually a little bit more risky and have higher returns. All things to consider, and you can use the online tools and or your friends that know more about this. You can ask them. If you found several ETF that fit your needs from different providers, you should choose the one that has the highest trading volume and the lowest expense ratio. So highest trading volume means that it's easy to buy and sell your shares at a fair price. And it's also less likely that this ETF will go bankrupt, because ETFs can also go bankrupt. It's something to keep in mind. It's also a good argument not to just buy a single ETF, but also spread a little bit between ETFs. And buy the one with the lowest expense ratio. So the expense ratio is the fee you pay every month or every year to that fund to manage your money. There's more metrics to choose, but I think those are two important ones. So an example ETF that you might buy is the ETF for the S&P 500. This is a common suggestion by financial advisors, including Warren Buffett, who I think in 2009 or something, maybe you guys know better, has said that he will bet anyone $1 million that the S&P 500 will outperform all hedge funds over the next 10 years, something along those lines. Do you guys remember that?
Yeah, I do. Yeah, it's true.
Heard of it.
So, and obviously he won the bet because he's Warren Buffett. He doesn't lose. And then, those are the rules to pick your ETFs, and repeat that regularly. That's the next step. So you want to repeat this whenever you have some cash lying around. I'm not great at this, honestly, but if you have a system, systems are always good, right? You don't have to think about it every month or every other month or so on. Put a defined amount of money into the ETFs you pick, and maybe once a year review your entire portfolio and kind of look at how well it did. If your risk tolerance has changed, if your life situation has changed, maybe you want the portfolio to become more risky or less risky, and so on. And then lastly, once your assets return more money monthly than your current salary, you can technically retire without changing your lifestyle, right? Your expenses stay the same, and suddenly your portfolio generates more money than your actual day job. You can't quit your day job, technically. This is not a suggestion. I'm just saying this is technically true. Mm-hmm. And this is what many people work for. Yeah, I think that's all I have.
Thanks a lot, Tim.
Yeah, thanks. Lots of infos to think about. I was also thinking about what should I do from a certain point where I'm staying at. Like I was having some ETFs already, but I couldn't really like decide on what factors base I should buy them. Like I was listening to my big brother who taught me a little bit about it. But I felt like, I just trust him, and I still trust him, but it's always better to know yourself. And now what I'm probably going to do is after this, gonna do some more research and probably also getting this S&P 500, which is not in my portfolio so far. And which I definitely think it should be there.
Yeah, it's just a common suggestion. It's the expectation of people is that the US economy will keep outperforming other economies, which of course no one knows, right? So it might be that the US will disappear, and then suddenly maybe Uganda will be the big economy. Like no one knows, and I don't want to say Uganda has a bad economy. I don't actually know anything about Uganda, but it's because I don't know anything about it. It probably means that it doesn't have a strong economy. But you never know what the future will bring. How did you, if you want to share, how did you How did you even start investing? How did you? Was it your brother telling you to start, Robert?
Just hearing from him at a certain point that he was starting to invest. I think he was also regretting that he started so late. This is basically 10 years older than me. And for me, it was like, for many years in my 20s, I didn't care about this at all. Like I don't know if it's like this for many people, but I was just, spending my daily life, spending money, earning money, seeing how much I will have at the end, and then maybe spend all of it, kind of like like this. What a certain point, I think when I was 26 or so, I felt like I kind of need to change that. And then basically, like what you also described a little bit, at first I was putting some money to the side for emergencies, like a few thousand euros, where I could say like, okay, if something happens, I can rely on that money. This was my first big step towards that. Like I was really just considering this, I think, kind of late. And after I've done this, I was asking my brothers, so like, would you do stocks? Would you do ETFs? He tended towards ETFs because basically you don't have to know as much to do it. And it's kind of like you also mentioned, like the risk is not too high with most of them. And of course, there's like no...
Yeah, especially if you're young.
Yeah. So I think it was like 26 where I started doing it. But I still didn't know so much about it. And this is why kind of like I was happy like that we met again and we talked about it, and that you suggested like we do this podcast episode together so I can learn some more, because I'm actually right now at a point where I'm more interested in it, and I don't only want to do it and only rely on other people, but really also know more about myself to make my own decisions. And for example, to not ask my brother anymore like this.
I mean, I think your brother gave you fairly good advice. Like, I think your portfolio, I mean, you did share it with me before this episode, and I think it looked fairly reasonable.
Yeah.
You did pick ETFs, in bigger markets and so on. I think most of this was pretty good. And I think the companies, I don't even know what companies they were, but I think they were fairly well-known companies, and I think that's good. And I don't want to suggest anyone using one company over another. I think there's like a misconception of many people, and I think it's disappearing now as people get more informed, but that the stock market is just gambling and it's really risky and so on. And I really disagree. I think your savings account is actually, in a sense, more risky than investing in the stock market, because of things like inflation. Because, well, first of all, your bank can go bankrupt as well. I think people forget that. Your money under the mattress can be stolen or disappear in a fire, right? There are risks associated with not investing into the stock market.
Yeah.
And I would argue that spreading your money over many companies is maybe safer than keeping it under your mattress or in a savings account. But it depends on your definition of safe, and also it depends on how long, as I said before, you're willing to not have access to your money. And yeah, so I think many people think that buying stock is like gambling, but it's not if you think of it as investing and not as speculation, because like it's not the same. What you often see in the media, in the movies and so on is someone buying some new company really low and then selling really high and getting super rich, and another person doing the opposite and losing all their money. And that's not really what it's about. It's about the long term, about spreading your money and waiting for the economy to grow, because really most economies keep growing over time, especially Western economies in the last 100 or more years, excluding times of war and so on, and economic crisis. But you want to partake in the growth of your economy and not just leave all the profits to the rich people that already own all the companies. So this is just a way to share in the profits generated by your economy.
Totally. I think it's also very important to notice what you explained, that it really depends also like how one person should or should not like invest. And I feel like many people who don't know about that a lot, like including myself, we tend to ask questions like, what's the best thing to invest in? And then the answer is, of course, it depends, because depends on what you explained, like the risk taking, or if you don't want to do it. For example, I was also starting recently.
Guys, I'm very, very sorry, but I really need to go.
Yeah.
We will be on time. I'm sorry to stop the podcast here, Tim, but like I can't really leave it on.
Sounds good.
I'm sorry. Sorry, guys.
All right.
It's been a pleasure, Robert. Really appreciate it. And thanks a lot, Tim.